So if you're someone that does real estate deals and you're looking to potentially scale up and expand, at some point capital is going to become an issue for you, right? Because you're going to need more money to come into the business in order to be able to buy and scale out to more projects. Now, most people typically start with family and friends as their lenders, right? And that's great, that's what I did. But what I wanted to talk about in this video is how to think about scaling the capital aspect of your business to a more professional degree, right? And we'll talk about how to actually find more people that can invest in your deals, how to actually, systematize and really make it more professional of an offering, and how to actually structure these deals at a level of scale. So we're gonna talk about this right now. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out tons of new videos all the time, talking about different facets of real estate and multifamily investing. So if that's what you're interested in, make sure you subscribe. And number two, guys, if you've been thinking about investing passively in real estate projects, right, whether you want cash flow, whether you want appreciation, right, we've got different offerings for you from our own projects. We've got so many of you guys on these videos watching and reaching out to us. So if that's something that you're interested to get a return on your capital, even if you don't want to be the person doing the work, make sure to reach out to our team and we will definitely help you out. So let's get right into the conversation. As I said, right, capital, if you're someone that's looking to scale, is going to become an issue pretty quickly, pretty soon, right? Because the more deals you do, the more money you're going to need, right? That's pretty obvious. And what I will say first to put some context to this conversation, first of all, I'm not going to be talking about equity lending in this video, right? So equity lending, if you're not familiar with it, is basically when you're raising money from investors in exchange for a percent ownership in the deal that you're doing. The type of lending I'm going to be talking about in this video is more of a private debt structure, right? So basically, you're going to be raising money, your investors are going to give you money, and in return, you're going to give them a fixed annualized interest rate on their money to pay them back in exchange for lending. So what that means is if you're kind of raising these funds, typically what you're going to be using these are for things like fix and flips, development projects, or something like BRRRR projects, if you're going to be doing buy and holds, right? Because, the thing is, when you're raising private debt, they're typically, you're typically raising these funds for maybe a period of 6, 12, maybe 18 months the most, right? But it's typically pretty short term. If you're going to be buying something, that doesn't need as much renovation, or maybe you're trying to buy large apartment buildings, right? Typically, you're going to want to raise equity, right? Because that's typically more patient capital that can wait while you go through, a 2 to 3, 4, 5 year turnaround, whatever that timeline may be. But again, for the context of this conversation, this is going to be for people that are doing, fix and flips, developments, BRRRRs, something that you're going in, renovating, and either selling or refinancing in order to return the capital. So before we talk about structuring the funds, right, let's actually talk about why you need those funds and what these funds are used for, right? Because, let's say you're a typical fix and flipper, or even if you're doing BRRRR projects, right? I mean, I've raised money for both. What you're gonna find out is you're gonna have, something like a commercial bank or a hard money lender typically lend you a portion of the acquisition, and then typically, pretty close to 100% of the construction proceeds, right? So like, on an average deal that I do, like let's say I'm using a hard money lender, they're gonna come in with 80, maybe 85, maybe 75, depending on the lender, percent on the acquisition, and then 100% on the construction of the construction requirement. That means you're gonna typically need anywhere from 15 to 25% down as a down payment of funds. But not only that, you're also gonna probably want holding costs, right? Because, as you scale out, you're gonna have a lot of different projects, right? So you're gonna wanna raise things for like holding costs, which is your mortgage payments while you're in the projects, tax payments, utility payments while you're owning the properties. You might wanna also raise money for things like soft costs. If you're doing gut rehabs and you're gonna need stuff, you're gonna need services like architect services, surveying, zoning attorneys, anything like that, right? If you think about it, if you're doing 5 projects at a time and all of a sudden you have bills coming in from all these 5 different projects, it can be pretty intense, right? I mean, not a lot of people can kind of float these kinds of costs out of their own bank account. So that's why, you know, it's a great win-win model for you as an investor. You can not only raise the funds required to get and buy the deal, but then also to sit on the deal and operate the deal until you sell out or refinance. Now, in terms of what to offer these investors, you know, I can only tell you from experience what I've done. So typically what I do is pay out in the investors anywhere from, you know, usually 11 or 12% to 15% annualized interest rates on their invested capital. Now, this range will depend on the types of deal, the risk of the deal, the locations of the deal, right? So there's a lot of factors that go into actually deciding where on that spectrum I'll go. But that's typically, that's typically what I found to be kind of the market, you know, for someone to lend you funds and you pay them back with a fixed annualized interest rate. Now, these, when you do raise this money and you do have someone invested, the way these investors typically get paid is they will typically get paid in monthly installments, right? So, you know, let's say you raise $100,000 at 15%. You know, that's going to be a $15,000 annualized payment. You know, you divide that by 12 to get your monthly payment, and that's going to be your monthly interest only, you know, payment that you're going to make to your private lender. Now, I have seen some private lenders that can structure differently. Some private lenders say, hey, you know, I only want payments quarterly. I have seen some private lenders say, hey, you know what, don't worry about it. Just pay me back all my principal and all the accrued interest at the end once you sell off or refinance, right? So I've seen both types of structures. Again, I think typically most private lenders like to see monthly payments coming in, you know, because the reason they lend is they want to create another income stream for them. So hence they ask for monthly installments, which, you know, I think makes sense. Now, in terms of now figuring out contracts and guarantees, before I get into the details, I gotta preface this with saying, again, I am not an attorney, I'm not a CPA, so make sure you talk to your own advisors before doing any of this. That's what I certainly did. But typically how I structure it is when I raise private funds, I will either personally guarantee the funds and or I will have the LLC that owns the property also guarantee the funds, right? That way, if anything goes wrong, you know, the investor has collateral in terms of the invested property. And then of course, if I'm personally guaranteeing the debt, then, you know, I have to back up that debt with my own assets and cash to make sure that investor is made whole. Now, as you can see, you know, there's obviously some risk for the private lender to invest in these kinds of deals, right? I mean, you know, projects can easily go south and some of this could, you know, and there's plenty of stories out there of people losing money doing this. So the point I'm trying to make, and kind of the next point of this, is a big portion of this sort of investing and lending is the relationship between the investor and the lender, right? Having a good relationship and having someone that trusts you is absolutely key, right? Because, you know, there's going to be a lot of components. Sometimes you're going to be delayed. Sometimes your projects take a little bit longer. And really having a great relationship and an understanding between the investor and lender is so critical for the success of both parties, really. So what does that mean to you as someone that's going to be potentially raising money? Well, you know, you've got to establish these really great relationships. And you know, and if you're asking yourself, how do I actually go about that? I mean, unfortunately, I don't have a magic pill for you, right? I mean, this really is something that takes a lot of time and a lot of effort. You know, I'll tell you guys how I've done it. It's taken years and years and years of, you know, a lot of content online, right? I mean, I do a lot of, obviously, on YouTube. I'm pretty busy typically on my Instagram, right? People see my projects. A lot of these a lot of these lenders or potential lenders are on my email list where I give out at least monthly updates of all my projects and everything I'm doing, right? So they can see what I'm doing on a consistent basis, and it kind of builds credibility. I've also, you know, back in the day, I would also go to a lot of networking events. I'd run my own meetups at my own project sites too. Again, trying to really establish credibility, relationships, and trust, because again, that's really key, right? I mean, you want people to see you face to face. They want to see that they're investing with a real person, how they act, who are they going to be someone that they can trust to make sure that they get paid back? These are all absolutely critical factors to making sure there's a great relationship between the investor and the lender. Now, some final key points and things to think about, you know, about this sort of lending and about this sort of relationship that you're trying to establish with potential private lenders. Point number one that I've learned, communication is so key, like hugely important, right? And here's what I mean, right? Like, usually what I like to do is give out at least monthly updates to all my investors that lend me money, right? Just so they know, hey, this is what's going on, everything's going well, or whatever, this is the progress we're making. And here's the thing, right? Even if the project is not going well, even if there are issues, you don't want to be that person that's like, oh, don't worry, everything's fine. And then, a couple months later down the road, be like, oh, I actually have a massive issue, right? Like, you don't want to be that person. Transparency is absolutely key. What I found is investors would rather know up front, like, look, if there's an issue, there's an issue. Like, what are we going to do to resolve this, right? I mean, most people are pretty methodical about how they approach issues. So you just want to be upfront, communicative, and don't just like call your lender 8 months later and be like, oh, by the way, I've got a massive problem, right? Like, I mean, that's just not going to bode you well. And point number 2, kind of similar to the point before. But one thing that I make it absolute priority, right? I mean, I think the relationship between, we talked about this relationship between the investor and the lender. One thing that I've done, and one thing I will continue to do, is I don't miss payments, because again, once you kind of break that, to me, it's very, very hard to go back. So that's my 2 cents on it. So hopefully this was helpful. I mean, again, this is critical stuff if you're going to be thinking about scaling, and taking down more projects. Of course, if you guys have any questions about any of these topics, I'm happy to help and share my experiences. Feel free to shoot them in the comments below, and I will definitely help you out.